Hi folks, Chuck Gibson from Financial Perspectives with March 2018's Charts on the Move. First off, I'm recording this on Easter Sunday, so I hope everyone is enjoying their holiday weekend. February's decline, followed by March's rally and failure to make new highs, has changed the dynamic of the market. Instead of trending higher, we have entered into a period of consolidation, and as such, I'm no longer strongly bullish, but instead cautiously optimistic the eventual move out of this range will be higher. Like all consolidations, we need to be concerned with the possibility the breakout will be to the downside, setting the markets up for a much bigger decline. If that were to occur, and I'm not saying it will, we will likely have seen the end of this current bull market and the beginnings of a new cyclical bear. Unfortunately, only time will tell what will eventually occur, but based upon the pattern being formed during this leg of the current correction, I'm heavily leaning towards believing we see a short-term downside followed by one more push higher before we turn out the lights on this 9-year bull market. With an overwhelming number of charts due to it being the end of the quarter and a limited amount of time, I'm going to jump right in. My first chart is that of performance of various markets. The S&P 500 was down 2.7% for March, but 1.2% for the year. U.S. small cap stocks were up in March by 1.25%, but have slipped 0.2% for the year. Europe was down 0.8% for March and 0.9% for the year. The emerging markets continue to show strength as they were up 0.5% and 2.5% for March and the year respectively. U.S. aggregate bond index climbed a bit in March but is down 1.5% for the year. Junk bonds are down both in March and for the year by 0.5% and 1.5% respectively. Gold continues to catch a bid, being up for both March and the year, but surprisingly, silver is not following suit and is down 3.4% for the year. This divergence will likely change going forward. And 3-month T-bills are now yielding 1.7%. And speaking of bonds, my next chart requires a double take as it shocked me. 30-year Treasury bonds yield rose 6.5% for the quarter. The 10-year rate rose almost 14%. The 5-year yield rose a bit more than 16%, while the 3-month T-bill rose a whopping 23.25%. Note, these are not the actual yields, but rather the percentage increase over the quarter. Wowza! I have mentioned in prior videos that inflation appears to be raising its head after an extended deflationary period, and my next chart of commodities shows this to be the case. Note how not all have risen, a sign that inflation is just awakening, but is still under control. But this is definitely something to keep an eye on in case it starts to pick up momentum. The CRB index was up 0.33%. Contributing to that rise was an increase in agriculture, energy, and precious metals, while industrial metals and livestock fell by more than 7% each. And from a U.S. stock sector view, cyclicals, technology, healthcare, and financials moved higher over the quarter, while industrials, materials, energy, consumer staples, and utilities dragged the overall market lower. I don't normally cover them, but I thought it worthy of a mention since last year's parabolic moves and recent crash made in so many cryptocurrencies. Most have been just absolutely creamed. Of the top 20 currencies by market cap, only one has shown a gain. Looking at the 19 losers, the smallest loss was 9%, while most have gone on and lost more than 50% of their value over just this last quarter. This is a great illustration of what happens after a parabolic blow-off caused by rampant speculation and the human emotion of the fear of missing out. Switching over to stocks and looking at the total U.S. stock market, you can see price fell by almost 12%, bottoming in February. Then it rallied up into mid-March, but it made a lower high. From there, it moved lower, but has so far made a higher low, creating this symmetrical triangle. During this correction, price found support and currently still sits above its rising 200-day moving average. A break of that support, the likely first target will be down here at the T1 area. It's safe to say there is no clear direction except sideways, and as such, there's no reason to be taking excessive risk. The market will eventually show its hand, which may take a lot longer than we prefer. I will speak to this in more detail at the close of the video. The next chart is that of a weekly look at Europe. Not that much different than US stocks, as they too went through a 12% correction and sit just above their rising 200-day moving average. My next chart is that of a different European index, the Stoxx 600 that I follow. I thought it'd be interesting to show you as it illustrates resistance. Keep in mind this is a 22-year chart. You can see this 400 level has rejected a rising price each time it was tested from the underside. And up until the 2015 test, it was followed by a significant correction. In technical analysis, it is said that the more times a level is tested, the higher the probability it will eventually give way. It's going to be interesting to see if 2018's retest will result in another significant correction or an eventual break to the upside. My next chart of the emerging markets has a similar message as those of the developed markets. Its decline was a bit more, closer to 14%, but its current price is further away from the 200-day moving average, pointing to a bit more strength. Additionally, you can see in the lower pane, which is the ratio of the performance of emerging market to US stocks, that it has been outperforming since early last year. Moving over to precious metals, the long-term base in gold is a very nice setup for much higher prices if it can break above the blue horizontal resistance. Additionally, price is above a now rising 200-day moving average. If price can break and hold above that 1370 to 1380 level, I think we see gold go back up to the 1600 to 1700 level over the next year or two. I'm not confident we will have begun a new secular bull market, but I do think it will provide a good intermediate term profit opportunity. The next chart of silver, it has me worried about gold. You see, when precious metals are moving higher, silver almost always outperforms gold. As you can see in the chart, it is not retesting the 2014 highs like gold is. In fact, it has formed a descending wedge pattern, which is typically a very bearish setup. Additionally, price sits below a declining 200-day moving average, which of course is less than ideal. This divergence between gold and silver tells me that either it is wrong to be investing in gold as it will turn tail and follow silver's path, or silver will play catch-up, setting up for a very nice rally in precious metals this year. Next up are US bonds. This is a 5-year chart of the 10-year US Treasury bond yield. As you can see, it has rallied and has almost reached its near-term target of 3% as expected from this breakout. A retest of the breakout would or should not be surprising. But based upon what the Fed has planned, it is likely this reversal will be short-lived and we will eventually break out above the 3% level. Taking a look at the same 10-year Treasury bond, except over a much longer 20-year time frame, we can see the current yield has run up against not only the upper horizontal resistance, but also this longer-term downtrend line, which provides an additional reason to struggle here. A breakout from this level has a target upside of 4.5%. Yeah, I said 4.5%. That's a 50% increase from the high it reached earlier this year. I'm going to close this video out by looking at 2 of the other double-digit corrections we have had during this extended 9-year bull market, with a goal of setting expectations on what we might encounter going forward. In technical analysis, you always look left to plan right. This next chart is that of the US Total Stock Market Index. As you can see, we are currently in this consolidation, which is, up until this point, has been a slightly less than 12% correction. Notice these other much shorter V-shaped corrections, like here and here and here. As you can see, the bulk of the corrections during this run-up have been of the V type. I did a quick informal study on a much longer time frame and noted that when the correction is double-digit, typically greater than 12%, they do not result in V bottoms, but instead a much longer consolidation occurs. Double-digit almost always results in extended, month-over-month, sometimes lasting years, sideways chop. The last double-digit correction we experienced started in 2015 and had price decline 16%. The prognosticators were out in force predicting the end of the world. Instead, it went sideways for more than a year, trapped in this rectangle. As we know, it eventually broke higher. It tested investors' fortitude by backtesting the top of the triangle and instead used that to trampoline higher. There is an old saying that if they don't scare you out, they wear you out, which is exactly what happened and part of the reason why, when we eventually started the new trend, it was so strong. My final chart is that of the US total stock market again, but this time going back 8 years to incorporate all major double-digit corrections since the 2009 bottom. The 2011 correction was a real pain, as it did everything it could to convince me that we had topped and we were entering into a new bear market. The lingering fear of the 50% 2008-2009 correction was fresh in investors' mind. Like 2018 and 2015, the top callers were out in force and predicting life as we know it had ended. This correction maxed out at 20% and lasted a bit more than a year. Notice how it eventually broke out, failed, fell back into the rectangle, found strength, eventually powered strongly higher after retesting support. If they don't scare you out, they wear you out. Having the luxury of hindsight, it's easy to see now that it was nothing but a severe drop in a deep correction. Why? Look at the highs and lows of each wave. Unlike the 2015 correction, price continued to make higher highs and higher lows, which we know is the definition of an uptrend. It's so easy to see in the rearview mirror, but it sucked living through it. There was no question about that. Armed with this history is why I've been predicting I expect the current correction is not done and probably has many, many months to eventually decide on whether price is going to go on to make new highs or new lows. Until then, we'll be trapped in a rectangle and chop around wearing out the remaining weak-handed investors. While this could be the absolute top and we go crashing down from here, it's way too early to make that call. Well, that is unless you're selling a newsletter. So, until the market shows its hand, I recommend being patient. When it comes to investing, I have found it's better to be roughly right than precisely wrong. With that, I'm going to call it a wrap. Until next month, I always appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with March 2018's Charts on the Move.